Fox Business Alert, I just want you to look at the Dow Jones Industrials here. Now we are down 506 points, so we are seeing some momentum to the downside here at the moment. The trade war is far from over. The Trump administration is now threatening fresh tariff rates of 10% or higher on 60 trading partners, accusing them of, quote, failing to impose and effectively enforce rules prohibiting imports of goods made with forced labor. Last night, U.S. Trade Representative Jamieson Greer's office released a list of all the 60 trading partners involved in what is now an investigation into those products. To name a few, the list includes China and Brazil, which could be hit with a 12.5% levy. The European Union, Canada, Mexico, and the United Kingdom, remember, with whom the administration already struck a friendly trade deal, could also face a 10% duty. This as hundreds of thousands of U.S. companies are still reeling from last year's billions they had to pay in tariff costs. Global medical device maker Medtronic announced during its earnings call this morning that it now expects a tariff hit of $250 million in its fiscal 2027 year. That includes $75 million during the first quarter alone. Let's talk about it now with Medtronic Chairman and CEO Geoffrey Martha. Jeff, you also had a stellar earnings report. We'll get to that in just a minute. But first, you actually lowered your fiscal 2027 tariff impact in your brand new report here from $300 million in the previous quarter to $250 million. But we just got this news about new tariff threats from the White House. Do you think you're going to have to adjust again your expected impact if these things go through?
Well, first of all, thanks for having me, Liz. It's great to be here again. And on the tariff comments, yeah, I mean, look, we've worked hard to reconfigure our supply chain to optimize that tariff bill. And look, for the med tech industry and for Medtronic, you know, we are 70% of what the U.S. healthcare system buys in medtech is made in the U.S. already, and like 80% of our supply chain is here. Mm-hmm. You know, the IP is here. Like 90% of the R&D is here. We're a very unique U.S.-based industry, and Medtronic as a company, and we're a big exporter. So you know, that really helps our tariff position and our discussions with the administration. But despite all of that, we are having a pretty meaningful tariff bill, and it's increased over one year to the next. Now with this new news, it's like, as you said, hot off the press. So we'll have to reevaluate that and see how it impacts our bill. At this point, it's too early for me to speculate on that.
How do you run a business in this atmosphere where the landscape is shifting underneath your feet? You guys need to plan, do you not? Last year, your hit was $185 million in tariffs, and now it could get worse. It is worse, certainly, but you're right, moderating it. It's like a moving target. How do you operate in that atmosphere?
Well, it does add some challenges. I mean, you know, for us right now, the fact that our growth is accelerating and it's profitable growth. I mean, it's really profitable growth, like from our cardiology business. That gives us a more of a cushion to operate in, but it is difficult. You mentioned tariffs. There's been input cost increases, like things like fuel. You know, has also been an impact. So it does. You know, the fortunate situation for Medtronic is the innovation is at a really good spot, driving a lot of growth and profitable growth, which helps us to mitigate some of these challenges that you're pointing out to on the cost line.
I mean, let's talk about how well you did grow in this most recent quarter. You saw growth when it came to the sales numbers of highest in 10 years. Your cardiac ablation solutions revenue up 78%. Very nice moves to the upside in business done both in the United States and internationally. So what do you think is the biggest driver there?
It's like we were talking about just a second ago. It's innovation. We've been working on a number of really impactful products in big disease states, things like hypertension. You mentioned atrial fibrillation, so a new procedure for atrial fibrillation, and also just surgery, the robotic penetration of surgery. So robotic surgery, those are three really big ones for us: hypertension, AFib ablation, and robotic surgery. Things like that are really driving a lot of growth. And then our base business, we're also, you know, meaningful iteration of our base business. Our 76-year-old pacemaker business had a really, really strong quarter as well. Our core surgical business, and our spine business all had really nice quarters, and then you have these big growth drivers on top of it.
Well, that to me is something that the investor is cleaving to right now. We are looking at a nice pop in the stock. It's been a little bit of a rougher road over the past year as you try and get that message out. There is also so much to talk about when it comes to your M&A activity, and it's been kind of creative. You've also been making almost a venture capital move and investing in some other technology.
Right. Yeah, we have, it's this past fiscal year, which just came to a close at the end of April, we announced or closed $2 billion in M&A, and these are mainly startup companies. I look at it as external research and development. So when you add that to our internal R&D, that's about $5 to $6 billion a year that we're deploying to innovation for patients around the world. And a lot of it is just buying companies, but as you point out, we have a separate venture capital group based in Boston that's making equity investment in startup companies around the world. We did 16 of those in the last year as well. And those sometimes turn out to be future acquisitions for us.
I do just want to quickly ask you, there was a letter put out by a business coalition that included everything from the consumer electronics makers, the automakers, but also med tech makers as well. And it is to the Treasury Department, to the Commerce Department, warning that this shortage in memory chips could really add a huge price increase across the board to American households. Can you tell me your thoughts on that?
Yeah, I mean, for us, most of ours is our revenue is business to business. We sell mainly to hospitals, so it wouldn't necessarily directly hit household costs. But yes, anytime there's a shortage of products, it's going to drive up costs. And memory chips for us aren't a huge component. But if you remember a couple of years ago, some of these larger nodule chips, these older chips that were in short supply during COVID, that was a big problem for us. We're not anticipating for us a really big issue with the memory chips, but I know for other industries it's more of an issue.
Well, there's always something to watch for. You got knives coming at you in all directions, but this most recent earnings report shows that you're fending off a lot and doing very nicely. Come back again. Thanks, Jeff.
All right. Thanks, Liz. Appreciate it.